Test 1 2 3. Test. Hi, good evening. Also, basically, let's before I get started, right? So, a couple of minutes more. So those are can see that some of you are already in. So for those who are in, I really appreciate that. I'm just doing a sound check right now. So can you just give me a heads up so just that you can hear me and as well as see my screen? Yeah, just a kind heads up. Yeah. Good. How about my screen? The screen that's showing Q4 2021 global markets outlook. Oh, you can't see the presentation screen. Okay, give me a minute. Okay, some of y'all can't see the presentation screen. I'm not sure why. Okay, let me check. Okay, let me click on the show screen again. Yeah, can see the screen now. The screen that's showing Q4 2021 global markets outlook. Good, excellent. So I believe that we kind of sort out the basic technicals we call it aspect of the presentation so that we could have a more a kind of a productive evening ahead. Yeah. So let's wait for one more minute. Yeah, one more minute for more to join in. Yeah. So before we get started. Yeah. Okay. So I hope that you all had kind of a quick dinner. Or maybe you can have a dinner as well together with the presentation. Yeah, because as you know that we are now kind of it's been about close to 2 years plus we have been in this kind of a strange new normal. Yeah. Okay, good. So let's get started over here. So before we start, right, let me so that you can focus on the screen, let me hide myself for a while. Okay, so good. So basically, right, what we are having this evening is going forward, what are we expecting on the global markets for the next 3 months, which is in Q4. So Q4 it will be starting, in fact, tomorrow, 1st of October, all the way until December. So as you all know that those who actually has been with me, my technical, my specialties lies on technical analysis. But nevertheless, I will share with you all how I combine fundamentals together with technicals to form a kind of a coherent view on the market. Okay, so before we get started, right, so let's take a look at the disclaimer slides first. All right, so while we're looking at the disclaimer slides, I hope that everyone can hear me as well as see my screen. So for those who are just joined, welcome to our Q4 2021 Global Markets Outlook. All right, so those who can't hear me or can't see my screen, just give a shout out, tap over here at the Q&A session so I could see your problem. Then we will try to actually help over your end. Perhaps you need to refresh the browser or something like that. Okay, so far so good, I believe. All right, so basically a brief introduction of myself. I'm actually the market analyst with CMC Markets. Okay, so for me, I would say my role over at CMC is definitely conducting webinars like this on market outlook, as well as education on how to trade the market using technical analysis, risk management, and trading psychology. So I will also write daily market brief and views on the market. Okay, so for those who are alpha clients, they actually get my we call it chart watch report that actually has this very detailed key technical levels to actually watch the asset classes that are highlighted. If there's a kind of a interesting trading setup in terms of clear trend bias, the time frame, and as well as the levels to watch. And for public, I also write daily extensively, almost every morning around 8:30 to 9:30, daily market brief. Okay, so later I'll share with you all where to find my daily market brief on the markets. Okay, so actually I posted on my Twitter, which is my social media. All right, so I'll actually answer it towards the end of the question, the end of the webinar. I'll show you all where to find our stuff in social media. So basically, yes. So basically, right before we kickstart, right? So Q&A towards the end. I understand that some of you all might jump in to write some questions on the chat box over there. I'll answer it, but I will actually take it towards the end, the last 10 minutes, to actually answer the Q&A. All right. So now this is a recap of what we have previously, Q3 outlook. Okay, previously. So previously, right, this is kind of a team play or the playbook. So we were bullish on the major US stock indices, and basically the S&P and the Nasdaq 100 made all-time highs and hit the first resistances at 44550s and 15,130, 15,300 that we highlighted 3 months ago, right? Which made our expectation. And at that point in time, we also highlight that over here, due to the flattening of the difference between the US 10-year and 2-year will lead to a potential outperformance of high quality US information technology stocks, communication services, and consumer discretionary stocks, while US cyclicals like the industrial materials or energy, we are expecting to underperform, which is actually turned out as well. All right. Then this one, it didn't turn out as within our expectation. Is we are expecting a kind of potential recovery on China big tech stock, but however, due to this further regulatory clampdowns on the edutech sector, which is another technology sector that's focusing on online tuition, and also a wider this regulatory clampdown has spread to a wider spectrum of China's private sector. All right, even the EVs right now, they're actually looking at consolidation, and definitely the property market in China. So this actually put a kind of damper and continue to add downside pressure on China big tech stocks. So we start to see the big tech stocks as a whole in general continue to face lackluster movement instead of a potential recovery. And so that didn't turn out as expected. And also, we just expecting a bit of dollar weakness towards the major range support, but however, it remains sticky towards the major range resistance instead. That means it didn't break the range resistance, but it started to go in a kind of a very messy sideways configuration in the last 3 months. Okay, then we are bullish on WTI Crude and Gold. So both managed to hold above their respective long-term pivotal supports at 57.25 and 16,070/40. So later highlight on Gold. Very interesting that this 1670 1640, very interesting that those who are residing in Singapore on August the 9th, you could remember that early morning Singapore time, there was actually a big sell-off in early Asia session, but managed to held above the held at a 1670 level. Then thereafter a recovery, it actually did a recovery from there. So later I'll highlight the gold chart for you all again. All right. Now, before we look into the fundamentals that I want to share with you all, right? Firstly, you all know that over here is that the most important thing right now, the pressing thing that we have in our mind is whether, okay, when will this bull market in the US stock market end? Okay, why US stock market? Because they are still the market leader. So let's take a look at previous market cycle or previous movement. Let's take a step back in time. So previous long-term circular bullish trend. We talk about long-term circular bullish trend is years, not weeks or days. We're talking about a very long-term trend. So the first one we started based on the data that I have is April 1942 to January 1973. From here, so it took shape about 334 months, and it has a return of 1,453 high to low. Okay, measure the high to low. All right. Then the next circular one will be October 1974 to March 2000. Right from here, and it lasted for 306 months. 2,000 over return. 2,000% over return. Pardon me. 2384. All right. Then definitely the current one that we have right now from the famous 666 low on March 2009. Currently, if you look all the way up to 24th of September, that's the current all-time high. Okay, it's about 150 months on it, and the return is definitely lesser than the previous two long-term circular bullish trend, which is close to about, I think, not even half. I mean, close to half. Okay, 580%. Okay, then now, yeah, definitely, if you look at this current circular bullish trend, is shorter in duration, but we also got to understand over here is that not all circular bullish trend are alike. There are various different fundamental factors that we got to take note of, especially at this point in time. Right. So basically, we know that over here is that this particular bull run has been supported by tremendous, this particular circular bull run. That means talking about the current one right now that has started on March 2009. So next year will be the, okay, in fact now next year will be the 13 year 13 okay, we go into next year March. Okay, so this current bull run has been driven by tremendous amount of liquidity that's been pumped into the system since the great financial crisis. All right, then you add up on to the trade war where the Fed is forced to cut interest rate. Then right now also the current pandemic crisis that last year it injected more liquidity into the system. In fact, not the Fed, it's the whole world central bankers. Okay, so now if you take a look at the current situation right now, that means we're talking about economic factors to look at this situation. Okay, so as you all know that US is still the largest economy, and US itself is driven close to 2/3 actually driven by consumer spending. Okay, close to that drives economic growth. So in order for consumer spending to spend more, there must be a bit of leading factor for it. So one of the leading factor to look at whether consumer will spend more is consumer confidence. All right. So this is the latest one, September preliminary data released from the compiled by the University of Michigan. All right. So I think 2 weeks ago they received, they actually come out with this preliminary one. So this Friday they will come with the finalized one. All right. So what's interesting over here, I want to take a look at since April, that means we're talking about Q2. Since April 2021, it has been declining. All right, it's been declining. So the latest one in September is 71.1. Okay, so you realize that over here there is actually a kind of a trend reversal, a potential trend reversal on the initial up movement after the pandemic low. All right. So if you look at it, that means what it's telling us that US consumer confidence is not as rosy as before. Okay, which i.e. it could actually imply lower consumer spending in the months ahead, in the next 3 months, which translate to potentially lesser profits for corporation. Okay, because if the consumer don't spend, I mean, at the end of the day, where the revenue will get, I mean, where will the corporation get their revenue? All right. Now, another one is now we're talking about corporation already. Yeah, corporation we break down into two different kind of business. One in the manufacturing, one on the services. Okay, services talking about IT, all these. Manufacturing we're talking about industrials. Okay, so we take a look at the big four developed nation that contribute the most significant global GDP growth. All right. US, UK, Eurozone, and Japan. So this from IHS make it. This is their latest September flash data. So I'll take a look at your manufacturing. So if you look at your manufacturing, your manufacturing output since Q1, Q2 this year, it actually the growth starts to decline pretty steeply. Okay, pretty steeply. over here. So what it means that over here is, okay, this is the 50 level mark. So anything that's above 50 we consider expansion. Anything that below 50 is contraction. So Japan has really reached a contraction state in September based on the preliminary data or flash data. So if you look at the rest, it's also coming down pretty closely like UK as well. But one thing I want to highlight is the steep contraction of growth in PMI data. This is what it means that over here, the manufacturing activities, right, of all these countries, of these big four countries, has already started to shrink, which is actually not good for economic growth going forward because these are considered as leading economic indicator. Okay, as you all know that GDP growth, right, quarterly GDP growth are actually lagging because by the time if you report a contraction in GDP, the economy has already shrunk. Okay, so before, in order to look at data, right, economic data, to analyze data according to markets, because as you know, markets are always forward-looking. Okay, markets will be the forerunner first to indicate whether there's a potential contraction or potential recovery in GDP figures. Then thereafter will be your other kind of leading economic data, such as PMI data. Then you have your consumer confidence. Then you have the business confidence. Okay, all these are slightly leading economic indicator. So another economic indicator will be the services sector. So service sector output, right, has also massively declined, not in terms of magnitude, slightly lesser compared to the manufacturing, but it also declined quite remarkably as well. All right, and Japan continue to be in the contraction mode. All right, so if you take a look at this supply delivery times, that means we're talking about how long do the end user receive their raw materials to in order to actually supply to order, how to put it, how do businesses receive their raw materials in order to finish their products, in terms of, like, for example, if you're a manufacturer, you need to produce a car. Okay, you need to produce a car, right? So before you produce a car, you need a lot of inputs from car, like the framing, something like that. Okay, in order to receive all those small parts and pieces of your finalized product, it takes longer and longer time. Okay, so what do you see over here is this was during the pandemic crisis. There was a supply chain crunch. Then thereafter it recovered again. Then you realize that since the start of this year, there's another global supply chain disruption keep on continuing. So it seems to me that the current global supply chain disruption is not seeing any end yet, and it continues to actually add downside pressure towards the we call it global manufacturer and global services businesses in actually producing their final goods and services. So that is actually not good as well. Okay, then what you see over here hand in hand, right, you actually drive out input costs because of global supply chain we call it disruption. Input costs, that means the raw materials that require to have the finished goods, rose as well, and it keep on rising. Okay, it actually didn't start to slow down. So basically, right, what we will understand over here is business costs is actually, it keep on increasing. So eventually, right, what we could see right now, right, an increase in business costs, right, will actually flow down to our end goods. The cost, the cost, we call it the product and services that consumer end user buy from these businesses, because sooner or later, I mean, at the end of the day, they got to meet their profit margin for to actually have a say to their shareholders. So in order to meet this kind of profit margin, right, they got to, and so that they can't take on too much cost by themselves. I mean, there will be a pass on cost. Later I'll share with you a very, okay, now let me share a very interesting chart on China. And before I jump to China, so just now that particular chart, right, was the services pardon me, the services and manufacturing PMI data for the other big four, UK, Europe, Japan, and US. Now it's China. So China Caixin manufacturing PMI for August. In fact, they will release tomorrow for the September one, the latest figure. They have already been in contraction. Okay, they have already been in contraction in August, ever since the start of, and its growth starts to actually decline steeply as well. Peak in the start of this year and start to decline remarkably. So manufacturing activities in China has already in contraction mode, 49.2, followed by their services PMI as well. Okay, so what you could see over here is growth deceleration or contraction in China. All right, then now take a look at this particular slide. retail sales declined remarkably as well. So it's the weakest growth. August figures show year-on-year 2.5%. Yes, even though it's positive, but it is now showing the weakest growth since August 2020. And look at it, how steeply it actually fall off since the start of this year. Okay, and now this is what I call the input cost. Business input cost for China is the factory gate prices. August figures show a plus 9.5% year-on-year. In the 8th consecutive month of increases in factory gate prices, almost reaching the high that was last seen in 2007 or 2008, prior to the great financial crisis. Okay, and if you take a look at it over here, right, this is the business cost in China. If you realize that over here, the pass on effect or impact towards the consumer has really starts to pick up in the last 2 or 3 months. All right, so August plus 1.2%. Okay, it's still below 2%, but notice that it starts to actually tick upwards. So what it could mean over here is that our businesses has starts to pass on their costs at a slower rate towards consumer goods and services. That's why you see the China core inflation rate starts to actually tick up slowly. So what it means, it actually shows a trend. Businesses are not going to keep absorbing a higher increase in business costs. Okay, sooner or later they will pass down to the end user, and we will start to see consumer inflation prices starts to tick up. Okay, start to tick up. Okay, slowly. Okay, then now with that in mind, right, let's take a look at commodity prices. Okay, you know that commodity prices is also one of the driver of global inflation. Okay, because like we're talking about energy, metals, agriculture. Agriculture is our food, basically. So if you look at energy, right, the one that is driving, okay, this is the Bloomberg commodity. So this is the basket that comprises of energy, metals, and agriculture. Everything, if you lump everything together, year to date return is 30%. All right. So the one that is showing the most return is energy prices. All right. Especially look at this one, net gas. So net gas right now is actually 300% because due to the last few weeks of crazy push up due to the lack of net gas supply. So actually I wrote this in my Twitter, my daily brief. So for those who have those who have read it already, it's a good piece of information why it actually causes net gas, why net gas prices is rising right now. Okay, so now if you look at over here, metals wise, right, if you look at especially this one called iron ore. Iron ore is negative so far for 3 months. So the reason why iron ore is negative, right, is due to China, because China right now is actually clamping down on their activities in the property sector, because property sector requires a lot of iron ore, requires a significant number of iron ore. So they start to actually clamp down the demand for this property development, so which translate to what you call it, downside pressure on iron ore. So but however, if you look at the rest, right, like copper and aluminum is still positive for the year, and definitely gold itself, right, is actually negative 8%, and silver is negative 50%. So that I'll share with you why gold is actually pretty much stuck right now. Okay, it's actually due to a competing instrument called the US Treasury yield. Okay, then food prices. This is food inflation now. So if you look at your agriculture from your wheat, sugar, soybean, cotton, coffee, live cattle, all of them has been increasing. I would say almost double-digit growth. Okay, since year to date percent. So what you could see over here is that commodity prices starts to increase significantly since the start of the year, except for gold, silver, and iron ore. All right, iron ore is actually due to the current, the unique situation in China right now. Okay, that the government is trying to actually clamp down on the property development activities in their property development sector. Okay, so with that, right, in mind over here is we know that over here is that commodity prices is slowly going up, i.e. it actually translate to central banks. If you look at the last few weeks of key central banks meeting, from the Fed, from Bank of England, from Bank of Canada, then you talk about Australia, RBA. So all of that has really made a kind of ECB as well. Okay, so except for ECB, but they did have an indication saying that, hey, the current QE program, we are not reluctant going to extend it anymore much further. So the one that is the currently most hawkish right now in terms of the developed central bankers, developed nation is Bank of England and Bank of Canada. So Bank of England, right, has really announced that they will start their QE before this year end, and even have an indication to start the first rate hike in, I think sometimes November or December, I can't remember, November this year. Then the Fed has really made very clear that QE tempering means QE reduction means no longer buying 120 billions worth of bonds per month in the market. They will start to reduce their QE purchase program starting in November, and hope to finish or finish tempering by around middle of next year. Next year. All right, but they didn't give a clear indication of when the first hike will come yet. But if you look at what's market's pricing right now, to kickstart the first interest rate hike for US, it will be likely in Q3 and Q4 next year. Okay, based on market Fed Fund futures pricing. So what you could see over here is it actually based on this kind of what I call more hawkish stance or less dovish stances by global central bankers has started to actually causes global treasury yields or sovereign bond yields, I would say, from UK, for even Germany and Japan, and even US. So I take the US one as a benchmark because as you know, the US is still the major superpower. So US 10-year treasury yield. Okay, so this is actually a kind of a risk-free rate. Let's say any corporation who wants to borrow any source of funding, they want to get a source of funding for capital investment, for long-term capital investment. Most of the bankers, right, they will actually benchmark with the US 10-year treasury yield plus their corporate borrower, whatever credit risk that they have. So definitely this is what I call a benchmark risk-free yield, risk-free rate for in terms of borrowing. So if you look at over here, right, since March, 0.33% low, right? Okay, so during this time, it start to inch up, and right now in the last 2 or 3 weeks, it start to pierce up as well, and almost want to hit the going to soon the 1.6% that high that was seen in March this year before it started to do a bit of retracement. So all in all, right, it has really jumped close to about 144 basis points, 144 basis points, which please it. So definitely, right, if this bond yield keep on increasing, right, that means what it actually translates is that, i.e., cost of borrowing will start to go up as well. All right, that means we talk about cost of borrowing will go up. So definitely the key resistance to watch is 2.5%. So if this level starts to have a clear breakout, that means this is monthly, right? So if it could have a monthly close above 2.55, that means what we could see over here is a major trend reversal of this circular downtrend that started in October 1987. So that is pretty much a big significant move that could actually cause, I would say that a negative knee-jerk reaction for almost all risk asset, including stocks, or even because at the end of the day, it will impact your valuation. Okay, as you all know that stock market prices, especially the US one, you look at S&P valuation is constantly relatively very high right now. All right, so with that in mind, right, over here, okay, so basically a bullish breakout about 2.5 indicates a potential significant increase in global cost of funding, with most central bankers have started to adopt a tighter and hawkish monetary policy stances now. Okay, then now very quickly, this is the chart that I will tend to watch almost every month, every end of the month, to take a look at it. Okay, why this chart is important is because every 40% decline in the S&P or more since 1970 has been preceded by a negative divergence seen in the S&P Bloomberg Commodity Index ratio, with this ratio here. That means what it means here. Okay, very quickly, right, the green line is the S&P. Okay, you look at the S&P here from December 72 peak all the way up to August 74. This 2-year bear market, 42%. So prior to this 42% slide, there was a divergence in this ratio of the S&P and Bloomberg index. So what it means that over here, it means that, hey, if you look at over here, both the commodity index and the S&P is going up hand in hand together. But however, if you plot them as a ratio, the magnitude of increase of the S&P is lesser than the commodity price index. All right. So what it means at this point in time is commodity prices is rising much faster than the rise in S&P. That means during this period of time, we are actually experiencing heightened inflation. Okay, so to combat heightened inflation, right, global central bankers got to tighten liquidity instead of keep on instead of cutting interest rate. All right, so that actually causes the stock price to actually fall. So that is the kind of a chain effect that we can actually that explain why these negative divergences in the S&P Bloomberg Commodity Index causes a fall in the S&P 500, which is translated to global equities. Okay, so it's very similar to the prior to the dot-com bubble, August 2000 and September 2002. This bear market over here. I mean, post the dot-com bubble. So you also have to see a divergence on the S&P 500 and Bloomberg Commodity Index. All right, and this one was the prior to the Great Financial Crisis, October 2007, February 2009. Okay, there's divergence. Then that lead to this bear market post Great Financial Crisis. Okay, so now what's interesting over here is that both of them have started to increase as well, but the increase in the commodity index is much more compared to the S&P. That's, you look at the ratio here, it started to flash this divergence. All right, so now to answer what is the lead time, because we know that this divergence has a kind of leading impact. I mean, that means divergence come first before significant correction on the S&P. If you look at the past 1, 2, 3 occasion. So let's examine, right, this previous three occasion, what is the lead time? Okay, let's look at this over here. So at this point in time, right, over here, there's this divergence that's being formed. So from here, right, the lead period was 20 months. That means after the divergence is formed, then thereafter, 20 months later, on hitting 20 months later hitting the peak, then it formed 42% decline. This one was 14 months. Then this one, the lead period was 9 months. All right. Now let's take a look at the, okay, one is 9 months, 14 months, 20 months. Okay, so you add that up together on the average, okay, it's about, 12, 15 months, they're about 12 months. Okay, so at this point in time, right, the negative divergence was formed on March 2021. That means on March 2021, there is a negative divergence. Okay, from here, because you look at the November and March is much lower compared to November. So at this point in time, March 21, negative divergence was being formed. So for March 2021, right, until now, which is September, that means from April, this end of March, pardon me, end of March. Then from end of March, that means start of April until end of September now. So it's 6 months so far. 6 months. So it's kind of approaching pretty soon to the lowest one, which is 9 months. After 14 months, right? The longest was 20 months in 1971 to 1972. So we know that over here is right. The lead time has really starts to getting closer and closer to the previous lead period of the previous divergences that causes the significant correction in the S&P. That means what it means that over here, right, these divergences continue to play out. Yeah, it continue to play out because there's no higher high. It continue to decline. It means this, even this low here, this high here is lower than this higher. So it's going to decline over here. So the lead month has really starts to be 6 months. The lead period, pardon me. So what it means if we're talking about end of this quarter will be 9 months really. All right, end of Q4 there will be 9 months. So it perhaps, right, is the risk, right, of that correction in the S&P seems to be getting higher and higher right now. Okay, if you look at the current situation right now, based on the current observation that we see. Clear? Okay, now with that in mind, right, that means what we are seeing now, right, is there's this risk of stagflation. So stagflation risk has increased. So what it means that we start to see peak growth. Okay, peak growth is number one, due to that PMI data that is pretty lackluster all the way from US, UK, Japan, Europe, and China. And we have higher commodity prices. We start to face global supply chain disruption. And we start to see higher sovereign bond yields. So all this, right, you have a low growth environment, low demand growth, and come with what I call a higher cost of businesses and higher cost of goods and services potentially to end user. So that particular what I call economic we call it downturn is stagflation. That means we start to see lower demand but faced with higher inflationary risk. That means when this scenario happen, right, global central bankers can't cut interest rate anymore. Okay, if the or can't start to do another round of QE. So if you're going to do another round of QE, right, the economic benefits will be, in fact, there'll be no economic benefits. Right, it will actually lead to higher inflation and lower demand eventually. All right, so central bankers, right, are tight. I mean, their hands are tight at this point in time because yeah. So with that, right, that means what it means that the liquidity tap that supports the risk asset, which is global stock market, is getting tighter or going to get tighter. That means there'll be less liquidity flowing into the global stock market in the next 3 months. All right. So now let's take a look at what we are seeing right now. Okay, so this was in Q3, right? So very quickly, right, at that point in time, why we actually looking for the previously banks and industrial materials, their outperformance may start to decline because of this yield curve that is coming downward, start to decline over here due to the technical configuration. At that point in time, right, because of the declining yield curve, it actually benefited the technology sector, the communication service, which is so like Facebook, uh, Google is one of them, and consumer discretionary. All right. So that was in Q3. So what indeed actually happened? So if you look at the last 3 months, information technology, communication services are top performer. It's up to 7%. So quite surprisingly, financial is at the top. The consumer discretionary rank fourth. Then you look at the cyclicals, right? The materials, industrial, energy at the bottom of the table. So that was actually due to that yield curve, the yield curve that is flattening. So what we are seeing right now, right? Oops, is this. Your yield curve now is actually going up. Can you see? Your yield curve now is start to turn up over here. That means the spread between the 10-year and 2-year. That means what I'm saying right now is that the 10-year rises faster than the 2-year. Okay, and if you look at the technical signal, right, there's a bullish crossover on the MACD of this yield curve, the 10-year minus 2-year, and it's actually where the crossover took shape, right? The crossover took shape exactly at the key support level. Okay, that means the decline at key support level, there's a bullish crossover. So what it means it means that momentum has starts to increase for this 10-year, 2-year spread, which will eventually start to see what I call in the last couple of weeks, this is a week. So you talk about last couple of weeks over here, or 3 or 4 weeks ago, we start to see the energy, the banks, and the financials. These are ETF. We talk about the US energy, banks, and financials. They start to actually tick up as well. All right. So what it means, right? Banks and energy may outperform in Q4 2021. All right, may outperform. But however, excuse me, industrials and materials, we got to be more cautious. Why I don't see industrials and materials outperform? Because industrial and materials, right, they do have a significant we call it a revenue stream that is coming from China. Okay, as you know that China right now is trying to engineer a slowdown in their economic growth. All right, through their clampdown in property, to the clampdown in China big tech. So there may not be a scenario where we start to see we call it energy, and it's called the industrial and material stocks to actually outperform. Energy, why? Because of WTI prices, the crude oil prices that is supporting US energy. Banks and financials, this US banks and US financial could be due to a better we call it economic condition in US, and also probably will last about 1-2 months before there's before the risk of a credit we call it credit deterioration impact start to comes into the market. Okay, so that's then definitely the one that may face the squeeze, the underperformance will be, okay, whoops. Okay, I think I missed out. Okay, sorry. This slide here, it should start to show the banks and the energy and the what you call it, the technology and communication services at discretionary, because they actually should be pointing downwards. Okay, so I think there's an error in my slide, so I will actually show the correct slide again on my Twitter feed. All right. Okay, now very quickly on the global stock indices, right? So this global stock indices over here, okay, let's take a look quickly on the performance. So year to date, right, the US is still outperforming. Okay, year to date, the fall by 18%. This as of last week, 24th September. S&P 18%, Nasdaq 100 18%. Then you have the Dow Jones Industrial Average 13%, and your Russell 2000 at 13% as well. All right, so definitely the one that is underperforming will be related to China, which is the Hang Seng and the Hang Seng Tech Index, negative year to date, negative 11%, and the Tech Index, because of the China Big Tech, Hang Seng Tech Index negative 26%. Okay, then the rest, you got Nikkei 225 10%, German DAX 13%, the ASX 200 11%, SGX, okay, Singapore Straits Times Index 7% plus. All right, then let's look at the technical picture. So this is what we have for Q3, the previous quarter. So we are looking for a further potential upside, holding above the 38,000 long-term pivotal support. Okay, 45.50, then followed by 46.30. So in terms of the Elliott wave, we call it the Elliott wave count or the factor analysis, right? This is the wave 5, the wave 5. That means after this wave 5, we may start to see a correction, the risk of a circular correction to actually correct the 12 years or 13 years of bullish uptrend since March 2009 low. Okay, so this Elliott wave count is actually in conjunction with that particular, the bearish divergence spread that I shared with you all on the S&P and the Bloomberg Commodity Index that is now showing a lead time of 6 months. Yeah. So so I actually link it up together with what we see early on from the fundamental perspective, and as well as the performance of the commodity prices versus the S&P. Okay, so now what we have right for this month is if you look at this month, it started to show a bearish candle. Okay, in fact, it's really due to today was the last day, so more or less it will be a bearish candle. So this was 22nd of September. We are prepared. So after 7 consecutive months of bullish candle since February, now it started to show a bearish candle on the monthly. Okay, so a bit of weakness has been seen here, overbought, but there's no bearish divergence yet at this moment in time. So what we have for the strategy over here is this. All right, so I will tighten the key medium-term pivotal support to 38,900. Okay, so previously was at 38,800. So I tightened it to 38,90. So what's 38,90, right? It's actually the pullback of this former expanding wedge resistance now turned to pullback support. So what we are seeing right now, right? It could, in fact, it will start to see this multi-week decline that I share with you all in my weekly outlook potentially. So 40.45 was the next support level to watch for, and also the 50-week MA. Okay, so as long as this potential pullback that's in place held above the 890, we may start to see a potential push towards the next resistance at 46.30, which is the potential wave 5 target. So, but however, if you have a weekly close below 38.90, then the risk of that circular, we call it corrective decline, to actually, I mean, we're talking about the invalidation of this long-term circular uptrend. I mean, that is more or less has reversed. The risk of reversal is very high if you start to see a weekly close below 38.90. So a weekly close below 38.90 should take us down potentially to test the next support at 35.10, then 3200 figure. All right, your RSI is still, there's no bearish divergence as well. It's still holding above the support at the 50% level. Okay. Then now next will be the Nasdaq. So Nasdaq, right, it broke above this 40.40 upside trigger level. So looking the down was to see 15,130 slash 15,300, then 16,630 slash 16,830. Okay, that wave 5 target. So yep, profit target has already been met. So what we see right now, right, on the weekly over here is there's no bearish divergence as well. RSIs are still holding above the 55 level. So potentially, right, what we could do over here is you may start to see a pullback that is taking shape right now. So as long as this pullback that is taking shape right now held above 13,820. So I tighten the key long-term pivotal support to 13,820. Why is it? Is this former swing high area here that was formed previously now turns to a pullback support, and as well as the 50-week MA. All right, that prices in this particular bull run, the current major uptrend bull run since March 2020 low has managed to help so far above the 50-week MA. So definitely this is a significant support level to watch. So as long as this support level holds, no weekly close below it, right, we are still expecting potentially another push up to test this next resistance at 16,630 slash 16,830. Right, but however, a weekly close below it will actually invalidate this bullish scenario where the risk start to increase for a trend reversal of the long-term circular bull run that has been in place since March 2009 low. So next support level that that we may see a further decline will be towards 12,050, then followed by 10,960 level. Then next will be your Dow Jones. In our platform, we call it US 30. So at the point in time, right, Dow Jones, what we have is that we have this long-term pivotal support at 31,200. So we are looking for a push up towards 37,050 slash 38,450. At the point that was Q3 outlook. So unfortunately, it didn't hit the target. Okay, it didn't actually went to the target of 37,050. Okay, quite close to it, but it didn't hit that. So what we do over here is, if you look at Dow Jones right now, right, Dow Jones, the weekly RSI, right, start to show a bearish divergence. Higher high, but lower high. So what it means, momentum has starts to weaken for the Dow Jones Industrial. So, but it's still holding above the 50-week MA, coming at the 32,800 level. So given this kind of mixed configuration that we see on the Dow Jones, right, I will be less hesitant to continue that bullish bias that we have in Q3. So for Q4, right, we desire to have a more neutral stance for the Dow Jones, based more like a sideways range between 32,800 and 3740 level. So that I have for the Dow Jones Industrial Average. Then now looking next for the Russell 2000 or the US small cap stocks. So at that point in time, right, we say that the 22,065 is the key support level to watch, but however, it got to have a weekly close above this stubborn range resistance that has formed since Q1 this year, which is at 2367. So unless we have a weekly close above 2367, then we will see further upside. Okay, so that was that Q3, we call it trend bias then. But however, so far, right, if you look at the current situation now, in the last 3 months, right, it's also trading below 2367. It's still sideways. So, and if you look at the momentum, the momentum is pretty stubbornly weak. So what you could see over here is that the momentum over here has been kept by a very significant descending resistance line. Okay, so what it means over at this point in time, right, there is no clear signs of a upside momentum that could potentially see the price action of the small cap 2000 to break higher. Okay, so with that, right, with the current what I call lackluster technical elements of the small caps 200, small cap stocks, small cap 2000, which is the Russell 2000, we will prefer a neutral stance right now in the next quarter in Q4. That means neutral, that means talk about sideways between 2367 and 2065. All right, more of a sideways range. Then next will be your Hang Seng. Okay, so if you look at your Hang Seng, right, Hang Seng, we were looking for a potential recovery in the China big tech stock, right? So hoping for it to actually retest the Jan high of 31,890 slash 32,300, with the key support level to watch will be at 25,760. So it has really broken below 25,760, a clear break below it. So what we are seeing right now in the Hang Seng, right, is actually now testing this very key significant support level, which is so currently actually from the February high, which is here, the February high, it has really declined by 24%. Okay, 24%. So now it's actually testing this 24,000 level, which is actually the very significant. Why is it significant? Because it's actually the long-term circular ascending trendline support from the October 2008 great financial crisis low. So ever since this was the great financial crisis, this is the major swing low. So ever since the major swing low, whatever decline that we see, this is the April 2015 decline to February 2016 decline. So this decline was actually triggered by the sudden shock Chinese yuan devaluation, where PBOC devalued the yen 3 times during this period, if you all could recall. So that kickstart, but it managed to help about this support and rebound. Then 2018 to this period over here. Why? Is because of the Hong Kong protests, and definitely this is the pandemic. So in these two instances over here, it managed to help above this key support level, and right now it's testing at this level again. Okay, so number one, definitely there's no signs of a bullish reversal candle yet, because this is a monthly chart. And what's interesting is the RSI is actually testing the support level as well. Okay, then if we zoom into the weekly, right, this is the weekly chart over here. So given there is no clear signs of what I call reversal, okay, and fundamentally, I don't think we may start to see a basing formation yet, due to the current stances that is adopted by the China central government. So I will definitely be more cautious right here. Yes, it's on key support level, but I'll still prefer to have a neutral stance. That's still more like a sideways movement between 24,000 and 26,770. So however, if we have a weekly close below 24,000, right, that means we start to see further downside already to actually retest the pandemic low of 21,480. Then if this level couldn't hold, we may start to see a further decline towards 18,050, okay, which was the swing low of this period here, 2016 and 2012. Okay, as well as a cluster of Fibo retracement level. So more neutral right now, rather than be adopting a bullish stance, despite it's still holding above a kind of a significant support on the Hang Seng or the Hong Kong 50 index. Okay, now moving on to the Japan 225. So Japan 225, right? This is the key long-term pivotal support that we have for last quarter, 26,880. Looking kind of a push up towards 30,490, then a break above should take us higher. Okay, so if we look at what we could see over here is for this quarter, right, the decline. Okay, this was Q3, so it eventually do a sideways movement. Then after the last couple of weeks, about 3-4 weeks ago, it did a burst up, and where it burst, right, very interesting, is it actually burst up right exactly at the 26880 long-term pivotal resistance that we have kind of predefined earlier on. So definitely this is the resistance level to watch. Why? Support level to watch. Pardon me, support level. This long-term pivotal support to watch, because it hasn't broken clearly above the first resistance of 30,490. Okay, so in fact right now it started to do a bit of pullback. So as long as this level holds, okay, so the intermediate resistance, the intermediate support, right, is the 50-week MA right now that's sloping upwards. It's coming in at 28,130. Okay, so definitely 20. So key support level will be this 26,880. So as long as this level didn't break down on the downside, there is no weekly close below it, we should see a slow churn up towards the next resistance at 33,520/34,050. So this also bear in mind the coinciding with the last push up for the S&P and the Nasdaq 100 as well. All right, so RSI, nothing, there's no bearish reversal, still has a room to actually potentially push higher before seeing this significant resistance at the 79% level. Okay, so that's for the Nikkei 225, the Japan 225 for this quarter. So now for the Australia, right, Australia 2000 will be this weekly, oh yeah, Australia 2000, yeah, Australia 2000. So what we see over here will be the last quarter outlook. So we are having this key long-term pivotal support at 6850/800 level. All right, so at this point in time, right, we are at that point in time, we're looking for a potential push up to test the upper boundary of this channel at 7950. Then above it will be 8200 level. So what we have over here is yeah, going to churn upwards, going to churn up, but it didn't actually hit the 7950 level. Then thereafter it starts to, you know, do that pullback, the pullback within the channel. So right now, right, definitely the 50-week MA is at the 6850/800 level, which coincide with the long-term pivotal support that we have in last quarter. So this level no change, okay, because no change, so we're still maintaining this level as the make or break level in order for this potential bullish move to resume, okay, towards 7950, okay, 7950, above it 8200. So this is kind of also kind of a residual push up as well. So, but however, if we start to see a weekly close below this 6,800 level, okay, definitely we're talking about that bullish now will be invalidated. Then we start to see a corrective decline towards the next support at 6,200. Okay, so that's the ASX 200 or Australia 200. Now for the German 30, the German index, okay, now German 40 already. Okay, so because of the inclusion of the 10 index. So at that point in time, right, it actually there's this impulsive sequence. So we are expecting it to go to 1685 and thereafter towards 17,800 level. Okay, so but if we look at the last few months, it started to be a bit lackluster. That means it didn't hit 16,685. Then it started to do a bit of what I call a very lackluster movement, just churns sideways but showing higher high. But doing this churning of movement on the upwards high, yeah, it still show higher high, but your RSI start to flash this bearish divergence. So what it means this the movement in the last 3 months, right, has been accompanied by rather lackluster momentum. Okay, that means momentum is not strong as indicated by this bearish divergence for it to see what I call a higher high. Okay, so what we have over here is, yeah, it's still holding above the support at 36. This is the intermediate support, 14,800/700. This is where we are expecting the current multi-week pullback to at least hit or store at this level. But definitely the long-term pivotal support will be at 13,600. Very clearly, this is the former major swing high. Okay, where it actually did a bullish breakout. Okay, after hitting October low. Okay, this is a bullish breakout from this kind of a major swing high area previously. So definitely this will be the key pivotal support level long term to maintain this potential residual final push up towards 16,680, then after 17,800 followed by 18,120. Okay, so with that in mind, right, so if we are talking about the global stock market indices, right, every one of them, right, we're talking about is showing that kind of residual push-up scenario. So definitely the weakest will be Hong Kong indices because of the number one, it's been kind of also impacted by the China central government policy. All right, so yeah, all of them are still holding on to support level, but we are coming very close towards the tail end of this major up move that kickstarted in March 2020 low, and also the long-term circular uptrend that was that 12 or 13-year uptrend that started in March 2009. Okay, now, okay, with that, let's take a look at the foreign exchange FX. Okay, so on the FX itself, okay, this is the year-to-date performance, start of the year until 24th of September. So what we could see is that it's actually the major currency together with the Aussie, Kiwi, China's yuan, offshore yuan, and Sing dollar against the US dollar. So what it means that over here is that if the lines are going up, okay, since the start is going up, that means the currencies, that means US dollar depreciating. That means all these currencies are actually outperforming the US dollar. So what we could see over here, right, if you look at since June this year, that means talk about since June this year, US dollar underperformance has started to reduce. Okay, that means US dollar is actually showing a bit of strength. And the three currency that is still producing a kind of positive a movement against the dollar is the Chinese yuan, which is still positive at 0.64%, but not that great, 0.64%. The Canada dollar, this means that means we're talking about Canada versus US dollar, means one Canada equals to how many USD? Is 0.64%, almost no change on the sterling. But if you look at sterling, right, based on yesterday's or movement, it should go into the negative territory area because this was 24th of September. Okay, last week performance, last Friday. Okay, so if you take a look count of the last 2 days, sterling has really been negative as well. So the one that is negatively, the one that's weakest against the dollar will be the Japanese yen at negative 6.71%, then followed by the Australia, then you have a Swiss franc. The euro dollar is weak as well, and the Sing dollar is about negative 2%, followed by the Kiwi at negative 2%. So what we could see over here, right, in the last 3 months or so, your dollar has been strengthening, not so much, but steadily. That means there's the strength in, that means there's dollar strength that has started to be started to actually shown up in the market. So what it means for the major FX pairs is, if I take a look at the sterling, okay, so sterling, right? If you look at it right now here, this is based on yesterday's price movement. I have the latest one, I refresh it. So what you could see, right, your sterling ever hit the May higher, 42.49, means 1.4249, which is also that, you know, this 43.80 swing high area over here. I consider this as a range top, a major range top, because this lasting for about 3 years, range top here. So in this range top, right, the prices starts to decline. Price action of the sterling start to turn down. And if you look at the RSI, right, what's so interesting about RSI is during this last push up, right, to the May high, higher high over here, your RSI is showing lower high. That means there's a bearish divergence. That means momentum is weak over here in this last push up, and the RSI broke below a key support level, which is the 51% level, which indicating to us potentially your prices could move much lower due to downside momentum has started to build up, as shown on the weekly RSI. So what we could see over here, right, is potentially, right, it could start to drift down towards the lower portion of this base. Okay, it's still this potential double bottom. It could be still a potential double bottom unless this support level has been taken on the downside. So what it means right now is actually churning, right, within this October 2016 to May 2021. It means 5 years of ranging formation. So now you hit the top of the range, momentum is weak, so indicating to us potentially there could be a further push down towards the bottom of the range. So yeah, so we got to we could actually turn bearish because there's still some more room more to go, given also the bearish technical for configuration that we start to see in the weekly RSI. So definitely key resistance to watch will be 43.80. So as long as this level is not surpassed to the upside, 1.4380, a break below 32.70, because this level here is pretty key as well. Previously resistant break, now turns to a support. So if this level is taken down to the downside, we could see it float down towards the bottom of the range, which is at 1.2730 slash 1.2490. So that's equivalent to 61.8% of the previous up move up from March 2020 to May 2021 high. This close to about 8 or 9 months of uptrend, 61.8%. Okay, which confluence at this level as well. So that's for the sterling dollar. So what we could see now is the euro dollar. So this euro dollar, right, ever since hitting is okay. So now there's a bullish breakout. So there's this bullish breakout above this long-term circular descending channel resistance. Okay, that was seen around October. Okay, October last year. Okay, so it broke out, hit a January 2021 high, which is correspond to the 2018 swing high here, and after that it just trade sideways. Okay, it means there's no momentum to go up higher. Right now, right, it's actually in fact inching lower to retest this pullback support level of this former long-term circular descent channel resistance, now acting as a support at 1450. Okay, 1450 here, which also confluence with the previous swing high as well. And your RSI is still showing downside potential to retest this significant support level that I drawn over here. There's still some more room to test, which implies that on a weekly basis, on the weekly chart or on the daily chart, there could be more room for downside. Okay, so if you could see this potential, this situation right now here, key resistance. So what I'm going to do is key resistance at 1.2340 for this quarter. So as long as there's no weekly close above this quarter, we may start to see a slow drift down to test that, you know, that former descending resistance now turns to a pullback support at 1450, then slash 1290, 1290 here, which is this level here. In fact, this congestion zone here, and also you look at the weekly RSI has kind of retested above this pullback resistance and now inching downwards back towards the oversold region. Okay, so I mean it hasn't hit oversold yet, but that means what it means that over here is that the downside momentum is still pretty much intact for the weekly RSI. So yeah, the euro dollar also facing some kind of downside pressure. So it's all going down towards the bottom of the range. So this one is more the halfway mark of the range. Why? Instead of the lower part of the range, because due to this pullback support level that is coming in at this zone of 1450 slash 1290. okay, for the euro dollar. So definitely if we start to see a weekly breakup above 123.40, this down move is kind of invalidated, and we start to see a squeeze up to test above this resistance level, and also close to the February 2018 high. This level here at 127.40, 128.40, 127.50, pardon me, slash 28.40. Okay, so now this is the Aussie. So Aussie dollar, the rally up from March 2020 low stopped right exactly at the confluence of resistance. 8070, this swing high here, January 2018, also the circular descending trend line from July 2011 high, and also the pullback resistance of this former support from April 2001. Okay, and it started to form a shooting star from there. Then thereafter, it just drift down, and now it's back to a 70 psychological level, which is 70 cents. Okay, your RSI also back to that pullback support level. So what you could see over here is a rather, yeah, it's at resistance, but now it's back to support. All right, and the candle is start to show, we call it a long tail candle. That means this was kind of like a bullish candlestick as well. So if you look at the current weekly chart, right, or what is it? Yeah, the weekly chart of the Aussie dollar. So it's kind of pretty much neutral. That means what we could see over here is there's no clear directional bias. That means we couldn't be outright bearish saying that this level got to break. Why? Because of the bullish candle that we start to see in the previous month, which is the month of August. And in fact, now it start to show another kind of we call it inverted hammer as well. Okay, so with these two kind of bullish scenario, we will not want to be so outright bearish. So instead, what we potentially see, right, could be more like a sideways movement between these two range, 80.75. So definitely what's 80.75 is this level here. Okay, between 80.75 and 70 cents level. Okay, so it's more neutral between these two big ranges itself in the next coming quarter. Then this one also is very similar to the dollar Canada. Okay, so you look at the dollar Canada over here, right? We have this impending bearish double top, but however, the recent pullback actually stopped last quarter. Last quarter it stopped at the neckline, its neckline support at 2070, 1.2070, and start to shape that rebound. It start to bounce up. And during this rebound, right now it start to form bearish candle as well. Okay, something like a doji and a shooting star so far. This is the monthly chart. And the RSI is now coming pretty close to the resistance as well. The former support turns to the pullback resistance at the 50% level. So with this kind of mixed element, right, that what we see over in dollar CAD. So I would, okay, because at this point in time, we will not know how it will transact unless this neckline support broken, then we could actually validate a down move. So if not, right, it could just like what we see in the last 3 months or 2 months or so, it start to churn between these two range of 30-20, means 1.30-20 and 1.20-60. So I will prefer to having a neutral stance due to this kind of lackluster or non-directional elements. There's no clear elements. Okay, to remain neutral between 30-20 and 20-60, these two level. All right, so right now, what you could see now on the FX pair, right, is we start to see more bearish kind of elements. It means on the euro dollar and sterling dollar due to the technical configuration. So, but not so bearish because we are still looking to kind of a further push down on the euro dollar and the sterling dollar, but towards the bottom of their range. Okay, their major range configuration. Whereas very mixed element for the Aussie dollar and dollar CAD. Okay, so now next, how about the commodities? Okay, so if you look at the commodity prices right now over here, like crude oil futures previously, there's a breakout of 660, so we are actually looking for a kind of a push up towards 70 and 87, this zone here, 75, 70 and 87 level. Okay, so then thereafter a break about 87 should take us up higher towards this area here, which is 103.90/110. So at that point in time, 57.25 was my key pivotal support level to maintain this bullish outlook or light crude oil futures, which is WTI. So what we could see in the next couple of months, right, it actually tested that 75, 70 in what I call 2 months. This is the third month it tests, and it start to form a bullish candle. All right. So this 29, so there was yesterday price. It started from bullish candle. So right now, right, if you look at the RSI is also pretty positive. This is the monthly RSI. Is showing higher low and higher high. Okay, look at the RSI. And the RSI still has room to push up before hitting an extreme overbought level at 79, which is correspond to the peak of July 2018. 2008, pardon me, 2008. Okay, so it's no change because it actually didn't break out above the 75-70 level. So no change, still using 57.25 as my key long-term pivotal support for this quarter. So if we start to see a breakout above 87, eventually it may test this range support here, this significant major range support that lasted close to 2011, 2005. So lasted close to 3 years, which is at 103.90/110. Okay, so still having that kind of bullish bias as long as 57.25 holds on like crude oil prices or WTI. But definitely, if you have a weekly close below this level at 57.25, we may start to see a kind of a invalidation of this bullish breakout, and it start to churn down to retest the April 2020 swing lower. Okay, which is at 1710/$10.65 for WTI. Okay, now next one up will be your gold. Okay, so gold at that point in time, right, we're still looking at this 1670/1640 as the key long-term pivotal support. Then still looking for kind of a push up, right, towards this 1965 upside trigger level. That means play up to the top of the range at that point in time. So right now, right, at the start of the slide, right, yeah, we are still holding above this key support zone. But why I'm reluctant to actually play up towards the top of this upside trigger level at 1965? Okay, what's 1965? Previously, so far, these two movement here has prevented further potential up move. That means prices hit, shape a decline, hit, shape a decline. This one come close to it, and push down. So this is a significant level in order for the boost to take out before we start to see further potential upside. So one of the reasons why I am quite reluctant to have the same idea that we have in Q3 was this graph. Okay, so this graph, right, is this gold futures. This is the gold price, the gold prices. This blue line is the US 5-year Treasury real yield. That means real yield I minus off the cost of inflation. So what it means over here is this. So if you look at gold futures prices, right, has been dipping downwards. Okay, so the previous up move, the previous steep up move from late 2018 until the high of August 2020, okay, has been accompanied by a dip down in the US Treasury real yield. Okay, and you look at the current real yield now, it's actually increasing upwards. That means it started to seem to form a kind of a base here and looking to probe higher. So what it means over here is that, i.e., the treasury yield minus inflation means we're talking about real yield. After inflation, the yield minus inflation has start to go up. That means you know that inflation is increasing as well. But with the real yield that is pushing up, that means we are talking about instead of inflation causing the yield to go up, it could be driven by central bank policy instead, rather than inflation. Okay, so with that in mind, right, it actually may cost higher. That means there's a higher opportunity cost of holding gold, because if you hold gold, there is no, interest rate. Is zero interest rate. I mean, you'll get zero interest rate. I mean, there's no fixed income for holding gold other than capital gain. All right. So if you look at it over here, unless you go into some structured instrument, but pure gold itself, there's no interest bearing income from holding gold. So if you look at the correlation, right, coefficient between gold futures and the US 5-year real yield, it actually started to increase because the inverse correlation. That means it's now at negative 0.60. Okay, it's started. So what it means is quite significant. So it means that if gold price real yield keep on increasing, there's a there's a there's a what I call significant impact, indirect impact towards gold futures. That means gold futures will tend to actually point downwards. Increase in real yield tends to lead to a significant inverse relationship between gold prices that causes gold prices to be lackluster, instead of going up, the chances of coming down seems to be higher based on this inverse correlationship of negative 0.6 between the US 5-year Treasury real yield and the gold futures prices. So with that, right, we could be, I would say that I'll rather be more conservative for this time around for gold, okay, to be more neutral. That means it may not, that means what I'm expecting over here is this big range. That means it may not even hit 1965, like what we have previously. So it will be sideways between 1965 and the key support at 1670/40. So this is the Singapore National Day, kind of a very strange early morning Asia session sell-off. Tested 1670, the upper boundary of the long-term support, and it start to rebound from there. And right now it seems to doing another attempt test of it as well. Okay, so more neutral between these two levels are 1965, 1670/40. All right. So now the next one that we will actually take a look at it will be cryptocurrency. So cryptocurrency has been quite interesting in the last couple of sessions, because if you look at the current rules and regulations, especially on China clampdown, it seems to me that cryptocurrency is still holding pretty relatively well, despite that noises, that clampdown that's come out from China recently. So if you look at the trend, this is the weekly chart of Bitcoin BTC versus USD. What we could see that the long-term circular uptrend still remains intact from 2015 low. Okay, so what you see over here, right, from the that was the previous high, then you start to see this drastic sell-off. Then it formed a kind of base formation over here before this bullish breakout that was seen last year. And since hitting the high of 64.90, that was in April this year, it started to pull back and start to do a bit of consolidation. So during this consolidation, right, it actually managed to help at the 50-week MA. Okay, and as well as this ascending channel support that I draw from the March 2020 low. So as long as this key support, right, that this 30,100 level holds, potentially, right, we could actually see another test of the all-time high, which is that's met in April at 64,900. A break above should take us to the next resistance level. This is a confluence of Fibo expansion level at 77,280, 90,800. Okay, but definitely if you see a weekly close below 30,100 level, this level is pretty important. Why? Because number one is in the last couple of weeks, right, during this hoo-ha period over here, actually tested for a long period of time before taking off. And right now it start to do a bit of pullback, but holding above the 50-week MA. So as long as this level holds, right, the biasness still tends to be more on the bullish side. But however, if a weekly close below 30,100, definitely all bets are off. We will start to go down back towards this former range resistance. Now turns into a pullback support at 13,870/11,775 level. Okay, so this is for Bitcoin. Then what we have over here for Ethereum. So if you look at Ethereum over here, right, if you look at the last few months of movement in terms of percentage, it seems to be much higher compared to Bitcoin over here. This is due to the technology that it has. Apparently there's more we call it crypto related service or products that actually right now riding on Ethereum technology, like NFT is one of them, and smart contract. So overall, if you look at the long-term circular uptrend, right, since December 2016 low, it still remains intact over here. It still remains pretty much intact. So what we have over at this coming quarter will be the key support level will be 19,300. Why is it? Because of also this congestion zone over here. The last few months of very weak sentiment where everybody at that point is expecting it to crash down, but it managed to help and stage the bounce. And also the 50-week MA, which is conferencing at 1930, 1930. So as long as this level holds, we could actually see a test towards the next resistance at 54.60, then above it 7600, 9230. Okay, which is so determined by a confluence of Fibo expansion level. Okay, so the current all-time high was 4373 in May 2021. All right, so at this moment in time, right, so this is the bullish move here. So definitely if we start to see a weekly close below 1930, right, I got to be very cautious. But however, I have this downside trigger level here, 1350, which is the former swing high area of June 2018. Okay, so this level, if this level also start to break down, then we start to see potentially a severe correction towards the lower boundary of this long-term circular channel, ascending channel, which is 488/358. Okay, so that's a huge drop back towards the bottom of this long-term ascending channel support level. So right now, right, yeah, the RSI is now kind of testing its pullback support and ascending support as well. So what we could see over here, right, potentially we could start to see another bullish upleg as long as 1930 holds on Ethereum. All right, so now I will come to the end of this presentation that I have over here. So now we are kind of open up to Q&A. So yeah, I see some questions with you. So before in Q&A, right, let me do something first. Okay, let me do some admin stuff. Okay. Okay, I'm back. Okay, good. So I see some questions over here. So a couple of questions is one of the questions is, do you foresee the Fed will be forced to continue the stimulus and stop the planned tapering? Okay, to force to continue the okay, so what it means that force mean keep on going ongoing that particular QE quantitative easing program. Okay, so if you look at the current situation right now in terms of economic situation, okay, so what we was what we see right now over here is definitely inflation is actually on the rise. Inflation, aside they do not want to admit it, they keep on saying it's transitory. But if you look at the various stances adopt and the dot plot projection, and some of the key officials stances, they are more in favor of what I call uh, to adopt a monetary policy to prevent inflation from running out of hand, because they do not want to come to the point that yes, if inflation starts to go up and they start to tighten more aggressively, by the time when inflation starts to rear its ugly head, it could have a much more negative impact on the real economy and as well as the markets. So that's their stances right now. So that's why I do not see it for them to U-turn this kind of a hawkish policy, or we call it a normalization policy at this moment in time. So in fact, what the Fed did over here is that yes, the Fed had already said that they will actually stop tampering. They will start tampering, pardon me, they will start tampering before this year end, but they give a bit of leeway saying that, hey, even though I tempered, I do not have an exact date yet when to actually kickstart the interest rate hike cycle. So they give a bit of leeway over here. Okay, so now the only reason that I foresee that this process could reverse, that means we're talking about keep on continuation of the QE bond purchase program, is that must be a very strong direct shock to the system. That means that there's a demand shock other than the Delta variant that we're seeing right now. So a demand shock could be an increase in geopolitical risk. That means all of a sudden there's a conflict somewhere in the world where certain major powers are involved. Okay, I'd like to stress out major powers are not some smaller nation, but major powers are involved. If major power involved, right, that could create a demand shock to the system. So that may actually force the Fed to adopt, to kind of reverse its planned tapering programs, unless that happen. Okay, So yeah, so for now, I still see they are actually more towards the hawkish side of the camp rather than for wanting that QE to keep on continuing. Okay, then someone asked me about the current energy crisis. Okay, let me share you about the current energy crisis. So the energy crisis right now, right? What we are seeing right now is actually two scenario that is driving. The first scenario is actually caused by this big push, towards ECG related initiative. You all know ECG, right? Environmental Social Governance. So there's a big push by the major countries like US, Europe, especially US, this since the new US administration that led by Biden. So climate change is one of the agenda. So in order to achieve climate change, you need to use clean energy, right? So net gas is one of the clean energy versus coal. So what we could see over here is there's a big push towards this usage of net gas. So yes, there was a big push to it. So what we see right now in the last few years, right, there is lack of investment in net gas supply. It means supply of net gas over here. So what we see over here, yes, there's a big push for it due to ESG initiative, but however, the infrastructure to get more net gas supply online is not there yet. And right now, what you're seeing is also a kind of winter a winter month in Europe side of the story that's causing what I call a mad rush of this net gas. Okay, and also after this mad rush of this net gas demand, because of the lack of infrastructure to support higher demand due to the big push by ESG initiative, and also speculators start to speculate these net gas prices, which are actually tweeted over here. So it's coming close to a base that's being formed, a close to 11-year base, the resistance. Okay, so there's a lot of we call it speculative money is flowing to net gas that's pushing net gases going up. There also, on the other hand, right, also China itself, right? China right now also started to use this net gas as well, because previously they're using coal. So what we see over here is that the Chinese central government has also had this big push of ESG since the start of this year, making it as part of their primary initiative, together with the clampdown in China big tech stocks. So there's a big push for China to use net gas as well. So China itself also previously there was a kind of they also produce coal, COAL, pardon me, coal, but coal prices, due to this big push by the China central government, producers has been forced not to produce coal, and also, that's why they have a demand for net gas, but unfortunately, due to what I call it the lack of infrastructure, right, globally, there was a sudden shortage of net gas supply that is able to come onto the market. So that causes this net gas prices to be so high. So you see, once net gas prices are increasing, right? If net gas prices are high, they will actually feedback. There's a feedback loop, feedback loop. So they will actually reduce energy, because to consume to prevent what I call this energy supply crunch, right? Chinese government has asked the producers, the what I call it, the manufacturers, to actually, do not run your factory to full capacity, because you need to conserve energy. Because if you don't conserve energy, right, your net gas, they'll be getting lesser. There'll be not enough net gas to actually supply the whole economy. So that could actually kind of kickstart that global supply chain disruption as well. All right, so that added on to the global supply disruption. So that could actually kickstart another round of inflation pressure via this lack of net gas supply. Then what is the after action that the authorities are asking the China manufacturer to do to conserve net gas consumption. Then with this, because net gas prices keep going up together with what I call all the speculative activity, there will be another flow, because net gas, if you can't get net gas as an energy supply, the next alternative energy supply will be oil. So that actually pushes up oil prices as well. So it kind of create a lot of what I call positive feedback loop on the energy related products prices. But this increase in the energy related product prices doesn't bodes well for the real economy. that what we explained earlier on due to the global supply chain from China or whatsoever. Actually, it actually intensified the global supply chain disruption. All right, so I hope that it's a bit long-winded. So I hope that I kind of answered that question on this energy crisis. All right, so how about STI chart? Okay, unfortunately I don't have an STI chart over here. I'll post it on my Twitter. So STI, right, is still there's a big risk that it may crack below 3040. Yeah, 3040. There's a big risk that it may crack below 3040. Okay. Do you think China big tech will have a chance to recover to previous growth trajectory in Q4 or even in 2022? Okay, so now the very interesting thing about China is over here is let me touch about the political situation in China. Okay, at this moment in time, what China is doing, okay, is actually good for the long term of their economy. Why? Because number one, they do not want any particular put it away, any particular corporation to be so big that's able to dictate or sway economic policy. Like for example, we talk about this what FANGs did. When FANGs are so big right now, it may cause a systematic risk to the US economy. Okay, because that's how huge they are, and the amount of we call it resources that they consume. If Microsoft starts to fall, I mean, it could be potentially it has an impact like a falling of a financial system potentially, yeah, because at the end of the day, it becomes so big that it becomes a representation of the system itself, and they start to sway policy making due to lobbying. So what Chinese policymakers saw that, hey, my China big tech stock seems to be morphing into a same path like the US big tech stock, which is the FANG. So to prevent them from getting bigger in a negative way, they start to clamp down them now. Okay, so that causes a bit of what I call medium term uh, movement on the Chinese stock market for it to, after hitting the February high this year, then after it start to inch downward. So while the rest of the world going to actually in a more of a less bullish trajectory, especially in the US. So it started to actually consolidate in the braver. Okay, so the key reason right now is that China itself has really started to do this kind of corrective movement while the rest of the world hasn't taken shape yet. So now if the rest of the world starts to correct after this whatever potential residual push up that we have that I shared early on, China stocks may not be so much impacted in terms of, because they already declined by a fair bit. So whatever negative impact has already been priced into the market. But definitely we talk about all markets, right? They are island together, so they are still kind of intercorrelated or interconnected, right? So no matter how China will try to actually prevent any spillover effect from the rest of the world towards their local economy, I believe that they could not actually escape from that, because if the rest of the world global stock market sneezes, I mean they sneeze due to what I call liquidity tightening process. China itself, I believe that we cannot potentially see a bull run in China, right? It's a bit we call it very strange, because since the whole way is kind of intercorrelated, because whatever products that China sell will sell to the rest of the world. So if the rest of the world is actually having this adverse economic slowdown due to lowest consumer sentiment, further kind of reinforced by the negative feedback loop that's been seen in the stock market, if that correction actually took shape after Q4. So Chinese stock market may be more like a sideways movement. That means they will start to see a big sideways movement. Yeah, they could fall a bit more, but maybe perhaps to a lesser extent. Okay, so what we could see now, right, is a more of a, to me, if I take into this consideration of a kind of a interplay between the rest of the world and China, I do not expect to recover so fast to whatever February high that we see in 2020. Instead, more that they may see a bit of push down, or but lesser magnitude compared to the rest of the world, the US stock indices, if a more significant correction actually materializes to actually retrace the long-term circular uptrend that is in place since 2009 low. Okay, so that's my take for the China stock market. So I still don't expect the big tech stock to shape new high from here, or to actually start, I would say, to put it away, to start shaping what I call new, to kickstart what I call a substantial multi-year bullish uptrend. Yeah, even though we're talking about valuation is cheap. Yeah. Do you think STI will go through a high growth period with government push for the IPO hub? What sector will benefit most? Okay, this one is more for long term, because if you look at okay, the funny thing about our, okay, in a normal bull market, right, we're talking about there's definitely a lot of IPO. So our IPO now is more on spec, SPAC. But if you look at Singapore market, right, the spec is already kind of pretty much matured already in US. So in fact, spec listing in US starts to kind of, you know, flow downwards lackluster. Yeah, I mean, it's still not too late for STI, the Singapore market, to be into this kind of new age kind of IPO listing called spec, quite blank check company, which kind of offer a bit more flavor towards the higher tech or higher growth company. So hopefully we're able to get something equivalent to SEEC, you know, Shopee, right, to list in Singapore via SPAC. So yeah, it's long term is good. I mean, long term, it actually offers more growth in a way that growth company into the STI. Okay, but what we could see over here is that in terms of sentiment, right, we might be a bit late away into the market. So usually, right, when this is kind of lagging thing, it's like a fanfare thing, you know. You know that before a peak in the market, right, there was this huge listing of, you know, what's hot in the market. So, you know, during the you know, the Singapore prior to the great financial crisis, means Singapore around 2007 to 8, there was a mad rush to actually list China as chip company in Singapore, if you recall. There was a mad rush because then all of us say, hey, why China, Singapore start to lead as chip company? Because it's so good, because China at that point in time has kind of entered into WTO, has really, you know, all the, we're talking about China being the next force of the global economy. So there's a lot of fanfare during that period of time, but that actually come at a peak as well. So what we are seeing STI doing is also potentially could be a peak as well, but that could be a long-term plan for STI to actually get rid itself from a very old kind of a, you know, boring exchange where it just comprises of longer we call it more stable cyclical plays and as well as REITs. Okay, so that is a kind of a potentially more vibrant trading environment for the STI. Hopefully able for Singapore Exchange, hopefully to able to get more fund flows coming into it. But that's more a longer term picture. But to me, right, if I look at it in terms of sentiment, it could actually be what we are seeing now is actually creating a peak in terms of what is very similar to, you know, what we have earlier on in where Singapore starts to actually prior to the great financial crisis in 2008, where we start to attract lots of S chips to actually list in Singapore. All right, so that's my take for that. Yeah. Yeah, anybody has any more question, because we are into kind of 10 minutes into 8:30 mark. Okay, so if no one has any question, right, let me share with you, all right, how to actually go to my Twitter. So this is my Twitter, right? So what I see over my Twitter, right, I tweet every morning. So this is my daily market brief of what are the key points that we have for, you know, today's at the start of the morning session, Asia session. What are the key things to take note of, and what happened last night in US? So I tweet this every day, okay, from Monday to Friday, and occasionally I will share some outlook as well. And for those who are alpha clients, they actually will have my more what I call detailed technical trading strategy set up on the, you know, various asset classes like US stocks, Hong Kong stocks, even the FX pairs. Okay, so how to follow me, right? So basically, you just open a Twitter account. Okay, it's free. Register for it. Then once you register for it, you can just follow me at Kelvin SC Wong. Okay, so this is my Twitter handle. So once you follow, so basically you ask, then you're able to, I would say, read my daily market brief and, you know, my market musing, my market, some of my market tweets, okay, on the markets. Then we have CMC channel as well. So what is this channel? Is our YouTube channel, CMC Market Singapore. So over here, right, if we will look at a couple of playlists, so if you look at market outlook, so basically today's webinar will be loaded up to the market outlook as well over here. So this one was the weekly outlook that I have earlier on from September. Okay, so basically this one was for this week. Okay, 20th, 27th to 1st of October. Okay, so I go back to all this. Okay, so this is the one that I have for this week. Okay, so on top of this, right, you also, this is the market outlook session. So what we could have over here is that if you want to have more of a trading education, right? Okay, so if you want to have more of a kind of a trading education, right? If you go to one called trading education here, so if you click on it, right, you're able to see this module. So there's 1 to 12, module 1 to 12 of Trade the Markets Like a Pro, where I share with you all how to use technical analysis and some we call it essential risk management tactic, as well as trading psychology to actually help us to navigate while trading on a shorter term horizon in the market. All right, so yeah, someone asked me, can you show us how to make use of your daily morning summary? So basically, what's my daily morning summary, right? Just to give a head start of what's happening in the market. Okay, it's not trading tips or something like that. So basically what I do every morning is I will actually share with you all. Okay, so what's happening in the markets right now. Okay, just a quick summary on, just get you up to speed the key themes in the market right now. Okay, then with that, right, you could actually help to look out for things that you could actually build in your trading strategy for the day, or something to take a note, the take a look out for. All right, so yeah, this is the kind of a daily market brief, right, morning summary that I hope that I could actually help you in terms of getting a head start of what's the key themes that is taking shape in the market at this point in time. All right, so I hope that that could actually answer your question. All right, so with that, right, I believe, yeah, we come a bit of extension, about 15 minutes, close to 15 minutes beyond 8:30. So yeah, I should actually stop here right now if there's no other further questions. So I wish you all pleasant evenings. Do stay safe due to the weird situation out there right now, and I hope to see you all again soon, pretty soon, hopefully physically. uh, when will be the next update? Someone asked me, next update of what, the quarterly outlook or something like that? Or we're talking about, oh, so the next quarterly update will come somewhere around the new year already. So we're talking about as we head into the new year. So we're talking about the first week of January next year. So, but definitely if the market starts to move, we call it significantly, and starts to do some kind of what I call a very weird behavior that start to break that support level, break my key support level or key resistance level or something whatever, especially the support level for the major US stock indices or the global stock indices. This is where I may do a ad hoc monthly update on that. Okay, so that could actually come in around November or December if that could actually happen. Right, so if everything move as according as planned, so the next quarterly outlook will be in the first week of January or the second week of January next year. All right, good. So with that, thank you for your time and do stay safe. And I hope to see you all actually in person soon, hopefully, if the environment permits. So if not, will be my next webinar session. All right, so with that, thank you for your time and have a pleasant evening ahead. Thank you.